even if we only replicate what happened between 2000 and 2011, and I think, what's coming our way is much bigger than that. But even if we only replicate that, then you're talking about several 100%. Gold doubled to $500, then it doubled to 1,000, then it doubled to 2,000. Well, if you do the math there, if it doubles, you're on 4,000. If it doubles again, you're on 8,000. If it doubles again, you're on 16,000. So all of a sudden, these numbers don't sound so crazy. And people will say, well, what kind of world are we going to be living in if gold is $16,000? Well, I guarantee you, if I'd said to you when gold was $250 that it was going to move to $2,000, by the end of the decade, everybody would have turned around and said, that's ridiculous. What kind of world are we going to be living in? Well, I'll tell you what kind of world we're going to be living in. Exactly the same kind of world that we're living in now, but with a lot more debt. And this Megaphone pattern is well documented. It's in all the technical analysis books. And I spotted this on the quarterly chart last year, and sort of theorized that price was likely to break out of this Megaphone pattern, or at least that when it does, it would be the signal for the next major up leg of the precious metals bull market. Now, going to the current chart and what's actually happened, you can see that that's exactly what's happened. And we pulled back in September. We got the September close, and then the December close was the breakout. We broke out. It was fairly convincing, but then what happened on the March close was extremely convincing. That's it. We're done. The Megaphone pattern has done its job, and all the Megaphone pattern is showing is increasing volatility as you progress from left to right. Each downswing and upswing becomes larger than the previous one, and from a classical technical charting point of view, you would have 3 touches on the upper portion of the Megaphone, and then 2 or 3 on the bottom portion of the Megaphone here. But the point is that you get some kind of reaction just before the breakout or just after the breakout to confirm that the breakout is real. We got our reaction underneath the breakout line, which is a variation on this textbook pattern where the breakout occurs and then you get a back test and then off it goes. So you'll find that with resistance lines on the charts all over the place. You either get a breakout and a back test and then off you go, or you get a pullback below the breakout line and then you just slice through it, and then you get your little pullback higher up and off you go. So you don't always have to back test this breakout line. We actually did do on a smaller time frame. This is the quarterly line chart, but if you were to look at the daily and the weekly chart, you'd notice that we did actually come back down and touch this blue line and then move back up. So all this chart is doing is it's joining together each quarterly close. What you can't see is that during each quarter there was a lot of volatility and the price was going up and down all over the place. But this is just joining up the quarterly closes. So we did actually get a back test on the smaller time frames.
So the Megaphone pattern is a highly bullish pattern, and when it breaks out, I mean, I'm thinking of the wall of worry with gold and how people, many people don't believe that it's a real run right now, but the Megaphone pattern is the kind of pattern that should ease some of those worries, right?
Well, what it does, Gary, is that it gives you a very solid support line. So if you're trading gold, taking an entry anywhere near that sort of 2050, 2100 area, you can have a stop loss very nicely set just below that breakout line. And if there's a little swing low under there on the daily or the weekly chart, that would be really helpful. So you set your stop loss just down here, and you set your profit limit up at $2,700, and that gives you a nice solid 3-to-1 reward to risk for your gold trade.
Yeah.
We put that in front of our website members and along with the silver trade as well a little while ago. So 3-to-1 reward to risk is fairly standard. It's not spectacular. You can get a 3-to-1 reward to risk on all sorts of investments at the moment, whether it's mining stocks or whether it's in other sectors. But of course, if you're accumulating gold and stacking gold, which is probably more useful for a lot of people, you accumulate below $2,000, you accumulate below that breakout level. See the breakout line there. All this last sort of couple of years have been an absolute gift for people who are wanting to accumulate physical gold and physical silver, because you're living in the knowledge that gold tracks loss of purchasing power. So you're guaranteed that at some point when you're building a bullish chart pattern, it's going to break to the upside and you'll get your rewards. So, gold does what gold does. And I've said it over and over again, it tracks loss of purchasing power. But as a trader, knowing where the breakout level is, very, very useful, because you can make a quick profit. You can make a quick 3-to-1 reward to risk trade on a clearly defined breakout. So if you're a stacker and if you're accumulating, great. But if you're a trader, knowing where these breakout lines are is crucially important.
So Kevin, you shared a chart of gold's cup and handle, and you asked, is the gold cup and handle chart structure one for the ages, a generational opportunity, if you will? So we spoke a moment ago. You see at least a 500, 600, 700% bull run after it pulls back. Can you talk about the golden cup and handle chart structure and what you see as a generational opportunity?
Yeah, these opportunities don't come along very often, and it's important that your listeners appreciate what's happening, I think, because the last time this happened was sort of 20 years ago, okay? And then, prior to that, it would have been, back in the 1970s. So, during your investing life, these breakouts, these beginnings of major bull runs don't happen very often. Now, the leg up from sort of $250 to $2,000 was impressive, and we've been consolidating that move now since 2011, 2012. So we've had more than 10 years consolidating that move. Just pause and think about that for a moment and what that might imply, because when that consolidation finishes, what do you think that logically means? You've had 10, 11, 12 years of consolidation, and that, I can now turn around and say to you that consolidation is finished, just like, back in the early 2000s, 2002, 2003. So that consolidation is over. So then we need to look at a whole range of metrics to estimate probable upside targets. And there's a number of ways of doing that. You can compare, the bull run between 2000 and 2011. You can look at the 1970s. You can look at a whole range of other metrics. You can look at things like the gold to S&P ratio, gold to NASDAQ, and you can start playing around with ratios and numbers and mathematics. And it's hard to avoid the conclusion that something, in the 10,000 area is entirely feasible. Even if we only replicate what happened between 2000 and 2011, and I think, what's coming our way is much bigger than that. But even if we only replicate that, then you're talking about several 100%. Gold doubled to $500, then it doubled to 1,000, then it doubled to 2,000. Well, if you do the math there, if it doubles, you're on 4,000. If it doubles again, you're on 8,000. If it doubles again, you're on 16,000. So all of a sudden, these numbers don't sound so crazy. And, people will say, well, what kind of world are we going to be living in if gold is $16,000? Well, I guarantee you, if I'd said to you when gold was $250 that it was going to move to $2,000, by the end of the decade, everybody would have turned around and said, that's ridiculous. What kind of world are we going to be living in? Well, I'll tell you what kind of world we're going to be living in. Exactly the same kind of world that we're living in now, but with a lot more debt. It's all about the debt. It's all about gold tracking loss of purchasing power. And it all goes back as well to that 10-year and 30-year yield chart, which is telling us that inflation is not going to be what it's been over the last 40 years. It's not trending down anymore. It's not contained. It's now free to do whatever it wants to do. It's broken out. And gold loves inflation. We don't gold. Look at the 1970s when gold moved from $25 to $800, $900. It doubled, it doubled, it doubled, it doubled, it doubled, and then it went up some more. Gold loves those inflationary and stagflationary periods, and that is pretty much the environment that we're edging towards. Rate cuts, interest rate cuts. Well, it's going to be tricky to do that in this environment for any period of time. And I suppose when the penny drops that rates are not going to be coming down for as far or as long as people might be expecting, and that rates are going to be perhaps doing something a little bit more comparable to the 1970s, then that's when it all, all of this ignites.
So that was a good, outline on the cup and handle. And speaking of a cup and handle chart structure, silver also has a similar and even longer and larger cup and handle structure than gold. And you recently touched on this when you shared silver, the coming resolution to a 45-year cup and handle is likely to be one for the record books. So let's dive into this one, and what time frame is it similar to gold? Is it a little bit longer than gold? Is it after gold moves then silver moves? What do you see the evidence pointing to?
Yeah, so cup and handle patterns are, and I can't give a precise answer as to why these perfect geometric arcs form all over the markets. All I know is that they do, and that spotting them is a real big advantage to traders and investors. So you can see horizontal support lines, resistance lines. You can see this this breakout line here, which I'll just highlight for you. It's very clear on the chart that when price breaks out of this containment, it accelerates to the upside. It's like a release of energy. So we all know about these support lines and resistance lines, which are straight, but these perfect geometric arcs are also very, very important, and they contain the entire basing period of a bear market, and they guide the price up in the early stages of its bull market. And knowing where this arc pattern sits helps you to identify where you are in the overall process. How stretched are you? How far have you got to go? Where's the target? When is the target? And we can zoom in on the silver chart. This is, as you said, this is now a 45-year cup and handle pattern. This is the cup in in the big cup here, and then this is the handle on the right hand side. If we zoom in on this handle, which is actually in the form of another arc, would you believe? This particular chart I issued 4 years ago and haven't really made any major changes to it. All I've been doing is just tracking it. If you follow me on Twitter, you're probably sick of the sight of this chart because I've been showing it for 4 years. And people get very emotional about silver. Oh, it's going down, everything's, silver's going nowhere. Well, okay, just follow the roadmap. We've got the roadmap. We know where it's heading in time and price, or where it's likely to be heading in time and price, because the arc is doing exactly what it did last time, and it's guiding the price of silver up. Thing with silver, as you can see last time, when it broke out, it had a very, very rapid move from $14 up to $50. And silver's a very spiky kind of market. It's very volatile. And when it breaks through key resistance, it tends to move up vertically. It did it here in 2020, of course. It broke out, and then it went vertically from, where were we, $17, $18 all the way up to $30 or so. So it went up sort of 60, 70% or some ridiculous amount. So it's important to identify where you've got key resistance. And we're passing through key resistance right now in the sort of 25 to 28 area. Whether 28 offers much resistance, I'm a little bit doubtful that it will. I think when we clear $26, I suspect 28 will come very quickly, probably just in a week or two. And that being the case, I think the amount of energy released there is pretty likely to push silver straight through 28, and I think we're likely to see the 30s coming fairly quickly. So although the right-hand corner of this arc is up here in 2025, 2026, what I actually expect is a little bit like the last time, is for a pretty rapid upside move over the next few months to somewhere in the upper 30s. We may overshoot into this area above $40. Silver has a habit of overshooting, but if you want to exit into strength, if you're taking a trade and you're entering now and you're setting your stop loss, I don't know, somewhere near $23 or something like that, setting your profit limit up at around $37, $38 would be a pretty good idea, because that would mean that you could exit into strength. Everybody's calling for $50. We may get 50, we may not. So I prefer to exit into strength with a nice sort of 3-to-1 reward to risk trade. And if it overshoots to 50, so what? I'm not too bothered about that, because it's sure as eggs is eggs. It's going to come crashing back down again and retest the edge of this arc. I do not see silver just slicing through 50 and going up to $100. It's not impossible, but I don't see that as being the most likely scenario. If silver gets say a weekly close above 50, above previous all-time highs, then in fact you can see the previous weekly close here. The highest weekly close, monthly close, was in fact where are we? Only about 30. No, it wasn't. It was 49.83. Yeah, so it's around about the 50 mark, isn't it? So if we get a monthly close above 50, then that's another lower risk, higher reward entry point, because then it's signaling that it's going somewhere way off the top of this chart. Eventual upside targets for silver is pretty much anybody's guess, but when you've got a 45-year cup and handle pattern, the very minimum target is the depth of this cup here, which is more or less $50 deep. So if you add $50 to the breakout level at 50, 100 is the very minimum first target, and I don't expect it to stop there during the next precious metals strong bull era.
And that's a good segue, because you had said in a post that there's no need for FOMO with silver, that we're a very long way from breaking out versus NASDAQ, and that when the bull run really starts, silver could be 50 before it even starts properly. So on that previous chart that you just left, that's the top of that cup and handle. But, part of me wants to say, isn't missing out on the move between the 25 and the 50 a significant loss for investors? But I am curious to know what the weight of evidence is showing you once it does break out of that cup and handle and gets on the other side of 50.
Yeah, and when you talk about silver being in three digits, $100, $200, $300, it's very hard to imagine that. So in terms of FOMO and fear of missing the move, all you have to do is look at this chart and you'll realize straight away that nothing has even happened yet. Silver's moved, what is it, from 20 to $25, and it's barely even budged this chart. This is silver versus NASDAQ. And you can look at silver versus the S&P or silver versus Dow. It's much the same. And what you need to identify on this chart is key breakout levels. Okay. Now, a bull market for precious metals, or a bull market for anything, occurs when it's above the 3-year moving average and when it's above something called the Ichimoku cloud. Now, if you haven't heard of the Ichimoku cloud, it's a technical indicator, and you can see the cloud on this chart. It's this red and green splodge thing. And what it does, it projects resistance or support into the future. So what we can see here is that in 2025, the Ichimoku cloud resistance is going to be, well, just exactly there where it is. Now, to be in a bull market, you need to be above that. To be in a confirmed bull market, the start of the bull market will obviously happen below that. But to confirm the bull market is real and genuine, and it's going to take us to much higher levels, you need to be above the cloud and above that green line, which is the 3-year moving average. And we're still way below it. Silver at $30 is probably not even going to be testing that green line. Certainly won't be testing the Ichimoku cloud, and it won't have pushed through the early breakout line, and it certainly won't have pushed through the final breakout line. You're probably going to be talking about silver at $50, $60, $70 just to actually start confirming that a new bull market is underway. And that's because you get this capital rotation from stock markets to commodities and precious metals. Every previous bull market in precious metals and commodities has featured this rotation of capital. Stock markets pull back, they suffer some kind of significant drop, and then they tend to sort of go sideways. They go up and down, but kind of sideways over a decade. And that's when precious metals have their time in the sun. Because the stock markets are going nowhere, the ratio of gold and silver to the stock market rises significantly. And you can see that's exactly what happened back in the early 2000s. We broke out above the final breakout line, above the green moving average, above the Ichimoku cloud. And that's when the weight of evidence, and it wasn't until 2003, 2004, the weight of evidence was really strong that this was the real deal. And from that point onwards, silver did an 8x. You can do the mathematics yourself. If silver is $50 or more, by the time it gets anywhere near this sort of breakout area, this cluster of evidence, then 50 times 8, $400. These numbers aren't plucked out of thin air. They're derived through sensible, normal mathematical methods using ratio charts and ratio analysis. If we're going to have a bull run anything like the last one, that's what you're looking at.
Amazing. So there's several commodities that seem to be somewhat to highly correlated with silver, sugar, and olive oil being them. The first one, silver and sugar, I believe that you have a chart showing the correlation. And can you share what you're seeing on this chart?
Yeah, it's interesting, isn't it? You get these correlations, and I'm not going to be able to properly explain why this would particularly be the case, because they're so different. What's sugar got in common with silver? What on earth? What reason could there possibly be for two such diverse commodities to be moving in exactly the same way? And there's one simple answer, Gary, and that is that they're both subject to the same capital flows. That's the only reason. Whatever the capital flows are driving sugar, then they're the same for silver. I know there's a whole lot of different uses for silver and a whole lot of different uses for sugar, but if you can train your mind to not think that way and train your mind to spot the correlations and spot the capital flows and accept the fact that it's the capital flows that are driving the price, doesn't really matter what uses sugar has. Sugar's used to make chocolate, it's used to make sweet drinks, it's used, the uses for sugar are not the same for silver. Clearly, I don't sweeten my cup of coffee with a spoonful of silver any more than I'd try and buy something with a spoonful of sugar. So they're completely different uses. Point is, they're being driven by the same capital flows. It's the capital flows that are affecting the price. What's causing those capital flows is more nuanced, but we don't need to know that. We don't need to know what's causing capital flows. We just need to know that they're both subject currently, and have been for a vast majority of the last 50 years, to those same capital flows.
And so the olive oil chart looks similar to this?
Yeah, olive oil, you can flick between any one of these commodities really, and you'll notice that what's been happening is a long period of consolidation, a long period of basing, and many of them show this false breakdown. Actually, I showed it to you on the 10-year yield chart and the 30-year yield chart, and there's numerous oil as well, of course, show this false breakdown from the pattern. It doesn't mean that the chart pattern was invalid. What it means is that when you get a false breakdown, the upside reaction is likely to be all the more violent. It's like stretching an elastic band, and it is really like physics in action. What you're seeing here is market demand being so far pulled one way that when you release it, it moves so far again in the opposite direction. It's physics at work, and has a lot of people talk about the beach ball being held underwater, and there's an element of truth in that. If you hold something down long enough, far enough, when you release it, the energy is going to be reflected in the move to the upside. So the global price of olive oil is another one of those commodities that's just the heat's been turned up in the pan and it's popped, and off it goes. And again, there'll be fundamental reasons that people will put forwards for what is happening with olive oil. But again, it's not, it's no coincidence. This is happening right across the commodities sector at the moment, and we're seeing silver approaching these breakout levels now. You could superimpose the silver chart on here, and it's just silver's kind of right about here somewhere. Okay, so we can use all of these chart patterns and all of this historic evidence to give us a really good idea what's likely to be coming next.
Yeah, so the correlation charts are really amazing, and I have a question regarding the correlation between mining equities and general equities. The S&P 500, NASDAQ, et cetera. Does the weight of evidence point to a high correlation between the mining stocks and general equities in general? And in the event of a broader market decline, like we've been talking about, would you expect the mining equities to decline? Or does it point to an uncorrelated relationship similar to the Great Depression, where the broader stock market fell really hard, yet the mining equities actually substantially rose.
Yeah, well, there's a couple of ways of answering that, and probably the more useful way of answering that is just simply to look at the mining versus SPX chart, because that's the one that will identify the capital rotation that takes place. So whether or not the miners move with the stock markets or against the stock markets is going to be open to a whole load of variables that will inevitably, the answer will be that sometimes it moves with the stock market and sometimes they move in opposite directions. So that then leaves you with, well, okay, that's not very useful. What I need to know is, when do I want to be invested in the stock market and when do I want to be invested in precious metals miners? Now, the ASA index goes back sort of 55 years, so it's really useful for historic data. And if I was to overlay GDX onto this, for example, you'll see that, let me just, what I'm trying to do is overlay GDX and ASA just to prove to you that it's a useful comparison. Okay, right. Okay, so the blue line there is the ASA chart, the ASA Gold and Silver Mining Fund, and the sort of gold-colored chart there is GDX. So you can see quite clearly, if I just do that and get the scales to match up, the GDX follows ASA tick for tick. Okay, so what goes for ASA goes for GDX. It's important to establish that first. So what I'm about to say here applies to the GDX ETF just as it does to ASA. So we're using ASA because it goes back much further. And spotting that capital rotation is important. So in 1985, okay, it was clear that rotating away from gold and silver miners and towards the stock market was the thing to do, because the chart was breaking down. Okay, when the chart breaks down, you want to be moving away from precious metals miners and towards the stock market. When the chart breaks to the upside, you want to be moving in the opposite direction, away from the stock markets and towards precious metals miners. Now, what's important for the current position and where we are now is that we're historically very, there are a number of ways of phrasing this, but ASA is undervalued versus the SPX is probably one way of putting it, although it's perhaps not the perfect way of putting it, because, you know, how do you define undervalued? But just because it's undervalued, it could get more undervalued. So, but the point here is that there's a support zone in here, and the previous lows here back in 2000 and in 2018. So having identified this support zone and the fact that we've just tested it, and in fact briefly punched our way below it, gives us something to go on. Okay, and I'm starting to think that we're seeing a major or a significant low point here. If I zoom right in, I'll get rid of that silly emoji there. We don't need that. That's for social media. But the point here is that if we break out above this declining resistance line, we break out around about there, then we're going to have strong evidence that this ratio is likely to move up to this upper resistance line, just as it has done on 2 previous occasions. The question then is, what happens to that resistance line, that breakout line? And if it pulls back, hopefully it's just a little pullback before a much more significant breakout. But this is likely to take us up quite rapidly. I'll probably need to reposition this arrow more steeply. And whether we get to that breakout line before the end of the year, again, also remains to be seen. So it's an interesting chart that tells you when to be rotating from miners to stock market and vice versa. The signal hasn't been clearly given yet that the stock market is going to roll over versus the miners. So although the miners are doing well, the chart hasn't broken out. When it does, if it does, then that will be a very strong signal that there's some sort of rotation taking place, at least in the shorter term.
Yeah, and it's interesting where you have the breakout line, how long it could take to get there. And when you think about a broader stock market decline, a pullback in gold, around that point might coincide, or would likely coincide, with a pullback in the miners if it does in fact have that breakout. And then the fourth punch attempt at the breakout line would actually bust through, and that's when you're seeing a 5, 6, 7, 8x.
Yes, I'm just comparing the angle of ascent here. You see this line that I've just cloned. So I've cloned that line there, and I put it on the first rapid upside move, and it's perfectly reasonable for it to move up that far, that fast. So that would take us to the breakout line there sometime in Q3, Q4, probably just before the US presidential election, which is interesting. So there is scope there for a rapid upside move ahead of the US election. There's something in the charts that seems to, multiple charts point to issues late this year, and of course we've got the US election in November. So whether there's going to be something that's related to that, or something else in the economy that's going on at the time, but there are warning signs for later this year.
Very interesting. Well, let's talk about copper for a moment. You've shared a copper chart recently where you stated, I have been tracking this ARC forecast for copper for almost 3 years now. Based on the chart, it seems that copper has stayed within the ARC pattern. What is the chart analysis telling you for copper in terms of direction and timing? And does it coincide well with the projected copper supply deficit that we've been hearing about that's coming over the next 2 years or so?
Yeah, again, just eyeballing the chart, you can see the similarities with what was going on. Sort of similar sort of time when precious metals were breaking out in the early 2000s, actually, and copper went on an enormous move from below $1 to somewhere up around $4. So, moved up several 100% there. So the same sort of chart pattern is developing now, or has developed. And very often these arc or cup patterns form some sort of a handle, and they often sort of reach their target and then kind of pull back. But interestingly, we've sort of developed this sort of pullback actually within the arc itself, which is another variation on the pattern, I suppose. But the key point here is that the geometric arc, and by the way, this is a perfect geometric arc. It's not something that I've just kind of drawn to make it fit the chart. When you use the tool on the software, it will only draw a perfect geometric arc. I can't distort that. I can make it smaller or larger, but whatever size I make it, that arc that joins those 2 points is a perfect mathematical geometric arc. So I can't kind of, if you're cheating it, you could sort of draw a line and kind of make it fit certain points. You could kind of, I don't know, distort it like that, or do some funny things to make it fit. But it's important to understand that this is a perfect geometric arc. So it's guiding us, or has guided us to the target, and it looks as though we're moving back towards that $4.50 area. I've said for the last year or more to our website members that it's really only a breakout above the 450 to 475 level that is really going to highlight the next major up leg. If we were to get a breakout there, then there's a number of ways of estimating the target, but one is to use this very simple sort of flagpole method, where you take the previous sort of move, which is the flagpole, to that flag, and then you replicate that. And this it's not just kind of guesswork. It works, a lot of the time. It doesn't have a 100% success rate, but it's one way of estimating. And we use lots of different ways of estimating the target. We use Fibonacci, we use this method, we use all sorts of different targeting methods to highlight where the target is in time and price. And you end up with a sort of a scatter of targets in time and price. But somewhere around about $6 area is likely to be a resistance level. So if we break out above this sort of 4.5 to 475 level, then I think $6 is the next sort of pausing area. And if that happens, then it's signaling to me, I think, that we have a more significant bull market ahead of us, notwithstanding any significant sort of any pullbacks or consolidations that take place along the way. But should copper break out here, then I think it's signaling a more prolonged bull market along with everything else.
Yeah. And there's a lot of data out there to support this with projected supply deficits going out pretty far after this year, I think, after 2024, 25.
Yeah, I mean, that makes a lot of sense. And it makes a lot of sense with the inflationary outlook. I mean, PPI, I think, is going to be under pressure. Producer price index that inevitably feeds through the system in time. Gold is currently probably reacting to what's already happened anyway. It's it tracks loss of purchasing power, and precious metals react to that. But another inflationary wave. It does start to sound a little bit like the 1970s. If we start to find increasing evidence of another inflationary wave ahead of us, with the current debt to GDP ratios that we've got, we can see quite easily a developing problem.
Very big
mathematically
problem, yeah.
A developing problem, and it's a little bit of a hard one to find a way out of.
Well, let's shift over to uranium. Uranium's been a big mover the last year. Kevin, it had a significant run up to more than $100, then pulled back into the 80s. Is the weight of evidence suggesting that the bull run is over for uranium? What's your long-term roadmap telling you of what's ahead for the yellow metal?
Okay, no, so the bull market is not by any means over for uranium if we look at the technical chart evidence. And this is a chart also that I put out, well, crikey, it must be back in 2019, 2020 now. I took my positions in uranium during that period, 2019, 2020, and have held a core position since and have traded this breakout move here. Along with our website members, we traded this move when we broke above 24 on the URA ETF and sold at the highs there just prior to this pullback. But you can see yet again another perfect geometric arc. Price broke through the 3-year moving average, through the Ichimoku cloud, hit the resistance zone, and we actually for our subscribers, we haven't been in uranium for the bulk of this period because we're aware of the fact that price had reached the initial target and was likely to consolidate and correct. So despite being halfway through a bull market, there hasn't been much going on in terms of trading for uranium for us until we got this recent breakout here. So we kept out of all of this kind of messy pullback that went on for a couple of years, I think it was. But no, I mean, we're above a rising 3-year moving average. We're above this Ichimoku cloud that I mentioned. We are starting now to get away from this volume resistance on the right-hand side of the chart here. You can see all this trading volume. And as price continues to edge upwards, then you start to move away from that trading volume resistance. So things look very bullish for uranium. We've got our initial and later targets marked on the chart there. So until that roadmap stops working, that remains our roadmap. The miners, by the way, have underperformed the metal significantly over the last couple of years, but they've massively outperformed the metal during the initial surge. Then the miners then underperformed the metal during this pullback, and now the miners are starting again to outperform the metal, which is what we want to see. So if the uranium miners can start to build a real breakout versus the metal, then that will be another very strong piece of evidence that tells us that this is going to be moving up towards our next target area. So it's all on track for the uranium miners at the moment.
So Goldman Sachs recently came out with price targets for Kamico about 30% or more higher than they currently sit. And the stock promptly rose by at least 8%. Others were up equally big as well. Is your analysis saying it's now time to get back in? And do you see Kamico making a similar 30 to 40% run in light of the new Goldman Sachs price target?
Yeah, so this is the Kamico chart here. Ignore the title; it says quarterly chart, but I've got it set on the monthly there for you. So we're looking at the monthly line chart for Kamico. We've reached the target. Okay, so when we initially reached this target, we played the breakout move in Kamico. We exited Kamico when it reached its measured move target because we knew it would take a little while to pause, consolidate, digest this big move that's occurred. So there are a number of ways of looking at the Kamico chart, and we can look at its performance versus the stock market. This is the middle indicator at the bottom. It says ratio versus SPX. And the performance of Kamico versus the SPX, it broke out back in 2021. That helped us with our confidence levels that the uranium bull market was igniting, and it has outperformed the stock market ever since. The recent pullback has not changed that, and we're starting to tick upwards again. The bottom indicator is the rate of change. It's the 7-year rate of change, and you can see that indicator is just starting to move up nicely. It's above its moving average. The green line here on all of these indicators is the 3-year moving average for the indicator itself. So what you want to see is the black line, the indicator, above the green moving average, and that indicates a bull market. Look on the left-hand side of the chart when we had a massive move from $2 to whatever it was, $50 for Kamico. Look at the indicators. Look at what this is what we're looking for. We're looking for the indicators to be steadily moving up above the green 3-year moving average. Same with the rate of change. And that's exactly what's happening at the moment. So there's nothing concerning on the indicators there. This top one here is the distance from moving average. Okay, it's how far stretched Kamico is from its 3-year moving average. So you can see quite clearly, I think, if I just highlight it for you, that there's a little zone of resistance here on the distance from moving average. And that's another one of the reasons that we exited the Kamico trade when we did, because we want to see that cool off and then potentially break out. So if that distance from moving average indicator now turns up and breaks out, that's going to support a huge move up for Kamico. Done about 30%, but it could easily sort of double, I think, from current levels within a. And again, you can estimate the time frame from that as well. You can use the angle of the previous bull market and just bring that across to the current bull market, and it helps you to estimate what's reasonable and what isn't reasonable. So, you know, you can quite easily see moving from where we are at the moment near $50 up towards $100 within the next sort of 12 months or so.
That's amazing. Yeah, so I've heard lots of different analysts speak on uranium and share their opinions on uranium. And many are taking the position that because of the supply deficit that's projected out till the early 2030s, that they're not necessarily going to expect to see a massive price spike and then drop as much as they are expecting to see higher prices for longer, likely 200, maybe even higher dollar uranium, but that it's not going to be a spike and a drop. What do you see there?
Well, what I see here is the uranium market behaving in exactly the same way that it did back in the early 2000s. So there's nothing yet that is very different from that. The rate of change indicator, you can see at the bottom there, has got a very, very long way to go before it gets to any kind of blow-off top. But that's what you need to look for when you're trying to time the exit of the bull market. There are a number of ways of doing that. But primarily you're looking for the capital rotation. You see here at the previous top, you saw this gradual decline in the rate of increase. It rose very, very rapidly, and it eased off and it eased off. And then there was a clear breakdown. So what you're looking for when you want to exit the market, you're always looking for a horizontal support level. And when you break below horizontal support level, and below key moving averages, I've got the 12-month and the 36-month moving average on here. If you break below those at the same time as the distance from moving average breaking down, then, and also notice here the rate of change broke down at the same time at November 2007. If I just put my cursor on it, you can follow the dotted black line up to the top of the chart there. So the rate of change breaking down below its moving average, and also the ratio versus SPX, and see it stopped rising as well. So all of these indicators you can use to time your exit from the overall bull market. You can play the trades on the way up, trading each sort of impulsive move to the upside, but there's no need to exit the market until you get that indication. I'm not really going to concern myself with how the bull market ends, whether it's going to be higher prices for many years to come, or whether it's going to peak in 18 months, 2 years time. I'm not less concerned about that, and just more concerned about spotting when it happens, and the charts will make that very, very clear for us.
Yeah. Well, so before we wrap up here and I ask Kevin our final question, I want to point everyone over to our Substack. It's free. Go to metalsandminers.substack.com. We post free content on the consumer, economy, markets, artificial intelligence, individual metals and miners, and all the interviews that we conduct. And when you subscribe, we want to give you a free gift. It's a report that we wrote based on the important Ray Dalio foundational premise. It's titled, "If you don't own gold, you know neither history nor economics." This free gift is a must read for everyone on why we all should be owning gold. So head over to metalsandminers.substack.com, put in your email address to subscribe, and receive this free gift on us. Also, Metals and Miners is a new channel. It's less than 2 months old. Please comment below, tell us what information you want to hear about, or just tell us how we're doing. And if you've enjoyed this conversation with Kevin as much as I have, please let him know. Hit the like and subscribe button and leave that comment below. Kevin, in wrapping up our discussion, I've got a question on whether or not you believe that there's going to be trouble in 2024 for us. So with everything that we've discussed today as the backdrop, do you believe big trouble is going to be hard to avoid this year? And if so, what kind of trouble are you expecting and that you want those listening to prepare for?
Yeah, there's probably just one chart that kind of sums that up, Gary, and I've shared this once or twice. We're keeping an eye on it for our website members, of course, but it's the 10-year yield minus the 2-year yield chart. It's the yield curve inversion. So usually, of course, the 10-year yield is higher than the 2-year yield. You need to pay more for longer dated debt. So when you do when you do the sum of the 10-year yield minus the 2-year yield, you should most of the time end up with a positive number. And you can see that on the chart. Most of the time, the chart is above zero. That red line is the zero line. But there are points in history when, for whatever reason, I'll remind you, I'm not an economist, so I'm not going to go into the reasons particularly, but from a technical chart point of view, there are points in time when we can observe that this chart moves below the zero line. Okay, now this is just about observational skills. You don't need to be a clever economist. You don't need to have a degree in economics to make these conclusions, because we can see very clearly that when you fall below zero and then the chart moves back to the upside and interacts with that zero line, then around about that time or in the months that follow, some type of crisis emerges, and it's always given a name. It's always, with hindsight, historians like to refer to it in some way or other. So we've got the early 90s recession, we've got the Asian crisis over here when we moved back up above the zero line. We've got the dot-com bust, we've got the great financial crisis, we've got repo, liquidity, COVID, all at that point here. So we've been below the zero line for a significant period of time, significantly longer actually than these previous occasions. And it's inevitable that we are going to move up and interact with that zero line in the future. Okay, now we've been building this bullish little flag pattern here over the last several months, and that suggests a likely upside resolution in the coming months. So to answer your question directly, I do think that in the months ahead, whether it's late this year or whether it moves into next year is debatable, but in the near future, the relatively near future, we're going to have an event, a market-wide event that's comparable or possibly worse than these previous ones. And I'm highlighting that with a risk matrix stolen from the world of meteorology and forecasting and risk analysis. It's an analysis of likelihood and impact. How likely is the event and what is the impact going to be? I'm assessing the impact as a high impact event. Okay, so when it happens, it's going to be a high impact event. We're not talking about something relatively minor. It's going to be, it'll shake the markets and cause panic. So it's a high impact event. So we know we're going to be in the right hand column. It's just a question of the likelihood. The likelihood at the moment is low because we haven't interacted with that zero line yet. As we get close to and interact with that zero line, the little check marker there, the tick, in the box will move up to a medium likelihood of a high impact event. And as things actually start to be falling apart in the markets, and as we start to see cracks emerging, major cracks, we will be in a high likelihood, high impact event. But just for now, we're down at the low likelihood, high impact stage. But keeping an eye on this chart will tell us, along with a few other charts, of course, and some of the ones that I've shown you already, will bring that evidence together and give us the advance warning, because we need to know this, because it's going to affect the metals, it's going to affect the miners, it's going to affect the markets very broadly, I believe, and really being out of the markets whilst that carnage is unfolding will be a smart move.
I really appreciate the warning here of this chart and the interaction with that zero line. And there's two observations I have. The first one being near the question marks, the red circle, the resolution seems to line up right around the election based on the flag. When I noticed that you had had the blue arrow, I noticed that the date was right around the November elections. The second thing that I would notice that I want to comment on is that it seems to me that when it does re-interact with the line after being below it, it introduces a black swan.
Exactly. Yeah. I hold my hands up and say, look, I'm not an economist. I'm not going to try and explain in terms of the economy and geopolitics what's driving this. But what I can say is that from a technical chart perspective, when you look at the 10-year yield, the 30-year yield, the environment that we're in, what's happening with gold, gold is often a little bit of a canary in the coal mine, letting us know that things are perhaps not as great as they can be. You look at the 1970s, the terrible economic backdrop that was going on there. So a whole number of factors across the markets and across the, when you're looking at money supply and you're looking at, you're looking at debt and debt to GDP and all these technical charts, they're all kind of giving us clues, and they're pointing to something that's coming down the tracks. It's not staring us right in the face at the moment, but later this year, I'd be getting a little bit twitchy that something is about to happen.
Kevin, this has been an enjoyable conversation. Thank you for coming on to the Metals and Miners podcast and for being so generous with your time, analysis, and ideas. It's really been fantastic to spend this time with you. Would you tell the viewers where they could learn more about your work and how they can connect with you?
Yeah, sure. Well, if I didn't send you all to sleep during that and the charts are something that you're interested in, then you can find me on X at North Star Charts. And we've got a subscription website. You may have noticed one or two little emblems on those charts there. I did try to take them all off, but one or two sneak through. So you can find us at northstarbadcharts.com. That's northstarbadcharts.com, where myself and my partner in crime, Patrick Karim, conjure up all these charts for you.
I'll put all those links in the description of the video. Thank you again for spending this time with us. Everybody go check out Kevin, his website, his charting, his Twitter. It's very important that you stay ahead of the curve here. Thanks,
Gary.
Kevin.
Appreciate it. Cheers, Gary. It's been fun.
When you subscribe, we want to give you a free gift. It's a report that we wrote based on an important Ray Dalio foundational premise titled, "If you don't own gold, you know neither history nor economics." This free gift is a must read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe. It's free, and get the free gift.